8. Now you're up to date from the Business News Network. So despite some solid earnings reports and guidance, the market's pretty mixed today. We're speaking closer now with Darren Farwell. He's the Senior Wealth Advisor at Farwell Wealth Management. He joins us for his take. Good to have you with us.
Thanks for having me here.
Talk to me about the macro environment in which we're operating here. You know, I've got viewers emailing me saying they're paralyzed with fear. They don't know what to do in this environment. Are you even doing anything?
Well, we are looking for select opportunities, but we're certainly not investing, whole hog at this point. And if people are phoning in saying, well, we're a little bit gun shy, they're not alone. When you look at the volumes on the Canadian exchange, we're down 16% in terms of volumes from where we were in the first quarter. Yep. That's a big difference. You look at the London Stock Exchange, the S&P 500, they're at 9-year lows for volume. So there is a lot of people sort of sitting at the sidelines waiting to see what's going to go on with these big picture ticket items like Europe, debt, U.S. debt ceiling, slow economic growth in the United States. There's a lot of people waiting to see.
When we have that low volume scenario, it often leads to high volatility. So if you step back, what percentage of your powder do you want to keep dry?
Well, that's a great question. Actually, right now, we're thinking that we'd like to see 10 to 20% of portfolios in cash, looking for specific opportunities in individual stocks, as opposed to the market as a whole, individual specific opportunities.
It's a stock picker's market.
Very much so. Good way of saying it.
But can we take a top-down approach? Can we start with sectors and drill down there, or even within those sectors, do we have to be worried?
In terms of sectors, right now we think we can start picking up some commodities. Commodities were hit pretty hard in June, and looks like we're getting a little bit of firmness in some of the commodity prices. So we are stepping in, buying a little bit in the commodity sector, particularly, of course, in gold.
Okay, so are you buying gold itself, or are you buying stocks tied to bullion?
Great question, too. Well, right now if we're buying it today, we're actually focused a little bit more on the gold bullion.
Okay.
We have been picking up some of the gold stocks in the previous weeks, but we've been looking at the bullion most recently.
So what do you just buy the GLDs and call it a day?
Just buy the GLDs.
We had one guest, and this really surprised me. I never heard this before. He was reading through the prospectus on the GLDs, and he had come across a point that said, well, if someone knocks over a Brinks truck carrying the GLD's gold from point A to point B, then GLD's not at risk there. It's the end customer who ends up getting hit. Is that kind of stuff even rank on your radar screen?
Well, that's an interesting comment, and I have to say I hadn't heard that one before. Yeah. I'll have to check with my little specialist back at the office to see what would happen if that were the case. But that's a very interesting point.
Okay, so where do you see gold going from here if you're willing to buy it now at these all-time highs?
Well, we think gold's going to go over $2,000 in the next couple of years. So our three-year horizon is over $2,000 for gold.
Well, then why not just buy the gold diggers who have, anywhere from $300 to $450 cash costs and watch the profits roll in?
That's a great question again. Well, companies like American Barrick, we do like to buy that kind of company when gold pulls back a bit, but they are trading towards the top end of the share trading range. So we're just a little bit cautious about buying them now, but we certainly will buy the gold diggers when the price is right.
On the commodity front, what about the soft commodities? Do you get into those areas there, or do you just, focus more on a company like Potash Corporation of Saskatchewan, where you're sort of exposed to commodities in an indirect way?
Well, we particularly like that fertilizer space because of the, the agricultural need around the world. So potash, agrium, companies like that, they've been highlighted on our models recently, and we are starting to pick away at those, especially with those great earnings from companies like Mosaic in the United States. Potash is reporting next week. That's one you can certainly look at. There's
Potash in New York revisiting a 52-week high. It's up about 74% or so. Is that an entry point here at 61 and change in the States or 58 in Canada, or do you want to wait for a pullback?
We believe you can still buy the momentum on potash.
Now, you mentioned Agrium and Mosaic. Those companies are a little more diversified than Potash Corporation. If you did not have exposure to the fertilizer space right now, would you want the diversified play, or do you want the pure play?
Right now, we're going for the pure plays. I think there's a lot of momentum behind it at the time being. So we're buying right now because of that momentum.
All right. Now, apparently you like my boss as well, I'm told.
Yes.
Not George Cope explicitly, although he's quite a gentleman.
I've never met him. I actually do like BCE. We were saying potash, that's in our growth models, a bit like Freeport, McMoran, because that's copper and gold. So our growth models are popping up with those kind of names. But when you look at the more conservative core positions, We love a stock like BCE because you're getting a 5.5% dividend yield while you wait for the stock to go back up to where the teachers were going to pay for it.
Right. Okay. So that's 51.75% dividend. But, you know, at risk of biting the hand that feeds me, why not TELUS? Because that's largely considered by those we've been talking to on the program as being the one that's got a little more torque than old Ma Bell and even Rogers Wireless for that matter.
Well, we think that the BCE management's done a very good job, and I think that that management really turnaround is what's making a difference at the company. So we think they're going to continue doing a better and better job, and that's what gives BCE a little more upside.
Okay. Let's come back to, you mentioned Freeport-McMoRan.
Yes.
Copper. It's called the PhD in economics for a reason. It gives us a real good sense as to the global economy.
Right.
What does the copper price today tell you about where we're going to be down the road economically speaking?
Well, copper price is firming up again, heading towards the upper end of the range at $4.40 a pound. So we think, again, it's another indication that commodity prices are firming up and that we're starting to see a little more indication that there is going to be the kind of growth we've been waiting for.
Why Freeport? Why not someone else? Is it because they're not a pure play and they've got that gold component?
Love gold. We like commodities right now, so they've got the commodities. We love gold right now. They've got the gold. You're also buying, of course, with the Canadian dollar. And the Canadian dollar at $1.0525 today. Not a bad time to pick up some U.S. assets.
So many Canadians have only Canadian assets in their portfolios. And we've been told, if you buy internationally, the currency ends up being a wash. Do you find that to be the case?
It could be. I mean, for example, if you look at the S&P is up about 6% this year, whereas the TSX is at 0. You should go, oh, I should have been in the S&P. Except for our currency is up 6%, so there's a perfect case of it being a wash. However, longer term, anytime you can buy U.S. assets with a strong Canadian dollar, over time, that's going to be a good trade.
Darren, great having you with us. Thanks.
Okay, thank you.
Darren Farwell, Senior Wealth Advisor at Farwell Wealth Management. For further market analysis, join us tonight on